Welcome to Illuminati Silver. We tell the truth about silver. Today is very late, Tuesday the 7th of January, 2020. And yesterday we published two videos entitled Traders Return, Gold and Silver Prices Rise, and Latest News and Views with Controversially Greg. If you haven't already listened to them, we seriously suggest that you consider doing so. And to help you find them, we've placed links to these in the description box below. Now, we thought today we would address very briefly the issue of stocks or shares or equity markets. With what has been going on in the Middle East recently, this has emboldened the pumpers to declare that we should expect stocks and shares to collapse and gold and silver prices to surge. Now, we confess, if matters do actually get out of hand, they will be right, but it's not a foregone conclusion that things will get out of hand. And if anything, according to one man in particular, we may see shares rise reasonably this year, and quite dramatically for a couple of years thereafter. Now, this man is not just any ordinary man, but is the Professor of Finance at the Wharton Business School, a name that may be familiar to many. His name, Jeremy Siegel, who actually and accurately predicted 20,000 Dow way back in 2015. So let's take a brief look at an article published by MarketWatch expressing his views earlier today. Man who called Dow 20,000 says one of the biggest stock market dangers in 2020 is, quote, people could be throwing risk to the wind, unquote. Published 7th of January by MarketWatch. I think this market is fully valued and not undervalued, but I don't think it's overvalued, said Jeremy Siegel. Actually, one of the dangers is that people could be throwing risk to the wind, and this could be a runaway. We sometimes call that a melt-up, and produces prices too high. And then if there's a shock, you come down to earth, and that could impact sentiment. That is Jeremy Siegel, Professor of Finance at the University of Pennsylvania's Wharton School of Business, expressing what he perceives as one of the biggest market risks in 2020 in an interview with Barron's Group's Market Brief, which aired on Monday. The Wharton professor, who forecast that the Dow Jones Industrial Average would see 20,000 at the end of 2015, says that market fundamentals are sufficient to support the recent run-up in US equity benchmarks, but worried that euphoria or a melt-up could take stocks to unsustainable peaks. That said, he thinks we're not quite at that juncture yet. Quote, I think this market is fully valued and not undervalued, but I don't think it's overvalued, unquote, Siegel told Market Brief, pointing to low interest rates fostered by the Federal Reserve and signs of a détente between Beijing and Washington on the tariff front as reasons for his fairly positive outlook. The academic's comments come as markets briefly faced selling pressure with the Dow, the S&P 500 index and the Nasdaq Composite Index on the verge of producing a second straight decline until bouncing back, following a US airstrike on Friday that killed Iranian Major General Qasem Soleimani, escalating Middle East tension that could ripple across the globe. Siegel, however, says that he's not expecting the Iranian developments to derail the domestic market or economy unless Mideast tensions flare up considerably more this year. The US, quote, is much less impacted by oil shocks than we were years ago, unquote, the professor said. I suspect minimal economic impact from this, adding that he believes that Saudi Arabia would also come in to pump additional oil to deflate the price of crude, which has soared in the past two sessions after Soleimani's assassination. West Texas Intermediate Oil for February delivery was trading at roughly 7-month highs, gaining 0.5% on Monday. As for his longer-term view, Siegel said he's looking at a more modest gain for stocks compared against last year's powerful annual rally. Quote, "I'm looking for a 0 to 10% increase in prices this year," unquote. In 2019, the Dow ended the year up 22.3%, its best year since 2017, while the S&P 500 saw its best year since 2013, gaining 28.9%. The Nasdaq also had its loftiest annual performance in 6 years, after rallying 35.2% in the year. Looking even longer term, Siegel is forecasting that the Dow may actually hit 40,000 in the next 4 or 5 years, unless something derails the market's bull run. Quote, "One could say we are 4 or 5 years away from Dow 40,000, unquote, he speculated. End of article. Well, this is an interesting take on events. With the Dow down another 119 points today, one should ask, is he going to be right? Certainly, President Trump will do all that he can to ensure that markets are rising in time for the election, and the economy is buzzing, if it's within his power to do so. It's also not impossible for gold and silver prices to rise as well as equities, though generally the equity market does have a habit of taking the majority of investable funds, leaving precious little for the precious metals. So what do you think? Do you agree with Professor Siegel? Or are you expecting equity markets to be much lower rather than higher by the end of 2020? Do share your thoughts, and meanwhile, if you haven't already done so, please subscribe to our channel, not forgetting to press the bell sign so that you may be notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.